Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Well, hello and welcome to Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Rima, and in just a bit, Prashant will be joining in as well. It's a Friday morning. Remember, it's not a long weekend, but we will be working on budget day. But plenty to track, Rima. We've seen a bit of a respite in the last few days. We've got the budget on Sunday. And in all probability, when we come in on Sunday, we'll know who's the new Fed chair as well.
Indeed, there's so much to talk about. But as you said, it's not got that Friday feeling because we've got only a short weekend, one-day holiday, and then back to business as usual from Sunday, 7 a.m. But quickly, to run you through some of the big cues. When it comes to Wall Street overnight, it was a mixed close. While the Dow managed to close in the green with a gain of about 0.1%, the Nasdaq ended lower by 0.7%. But here are two things to note. One, there was a fair amount of intraday recovery that we saw. The Dow managed to recover nearly 450 points from the intraday lows. Even the Nasdaq recovered from the session lows, but it was still weighed down by the 10% fall that we had in Microsoft. While Meta and Apple did well, Microsoft was the big drag, and that put pressure on Nasdaq overnight. The other big story in global markets overnight were these large swings that we had in gold and silver. Look at silver in particular. Silver saw in the last 24 hours saw a high of nearly $122. It dropped down to levels of 106, and now it's back to levels of 110. So very, very wild swings seen in gold and silver after the near parabolic moves that we had. When it comes to the Indian markets, we've had 3 good days on the trot. 24,900 is where the markets, the Nifty at least, seems to have made a double bottom twice. And from that level, we've climbed to nearly 25,400. So that is an improvement of 500 points. But yesterday, we once again had that sell figure. And today, there are 4 Nifty companies which report their numbers: NTPC, Bajaj Auto, Nestle, Power Grid. Tomorrow, that's on Saturday, Sun Pharma will be reporting numbers, and so many earnings reactions also to navigate through the day. But we'll discuss the cues in greater detail, the earnings reaction. But before that, Nigel, what are the cues that you're looking at and the setup?
Well, Rima, the last couple of trading sessions, the intraday dip has got bought into. And given that the GIFT Nifty is suggesting that we're likely to open up with a gap down of close to around 100 points, I'll be interested to see whether or not that dip does get bought into, because the last few trading sessions at least, traders actually have been successful. So maybe, initially we will see a bit of a recovery from the lows, and let's see whether or not we sustain. But I think that dip gets bought into. One problem that we've seen the last few days is Brent crude prices. We were sitting comfy. Brent crude prices, $62, $64 per barrel. Now, that number has moved close to around $70 per barrel because of the cuts that we are seeing, in the United States and various other factors, geopolitical tensions as well. You don't want this Brent crude price to go out of whack. Till $70, $75, I think you're okay. You don't want it to go higher than that, though you want a suppressed number in terms of Brent crude prices. What about the flows? The DI buying offset the FI selling, and good to see. The FIs now are selling a measly 400 crores. Well, I'll tell you what, we'll take that. A flattish, a negative 300-400 crores. Par for the course, if they turn buyers, even better. But institutions were net buyers. Well, the FIs, everyone's wondering whether or not they're covering shorts. And that's why this market is going up. Actually, that's not the case. They went ahead and they added shorts. They've added close to 12,000 short contracts. The short positioning has moved to around 88%. And the shorts are in the system. So we need to look for that good news. Whether it comes from the globe, whether it comes in budget 2026, that's going to be important because some of these shorts will be scampering for cover. Given that the FI positioning has now moved to net short of around 1.85 lakh contracts. Clients, they're doing the exact reverse of that. They've gone ahead and they've added some long positions, holding at around 1.3 long contracts. But what about stock futures? Well, the FIs, they added some kind of shorts out there. While there was some long unwinding that we've seen, but that's more an arbitrage play, I think, so with regard to what they're doing in the cash as well as on stock futures. The encouraging sign came in on the index options front, because yesterday, after a while, they wrote close to around 3 puts for every 1 call. So telling you that maybe in the near term, there is some sort of a base inside. Going to the options data then, given that we have a very, very big weekend that's coming up, the 26,000 call, there is some out of the money call buying yet again. Last couple of trading sessions, you've seen that. If someone is willing to go in there, take a bit of a punt and, buy that strike for around 30 rupees, and all you lose is around 30 rupees. While on the flip side, there is some writing as well in the near term. That 25,450 call, that's seeing a good amount of openness build up, with the premium at around that 200 rupee odd mark, which brings us to the levels. The 20 DMA, that's going to be important to track from here on. We need to get past that to feel for the momentum on the upside. While the 200 DMA, that'll be the first reference point on the downside. Till that 24,900 mark does hold out, you'll have to say that the bulls will believe they're still in the game. And the Nifty Bank, that's the one that's kept them in the game. It's been moving from strength to strength, almost at a fresh all-time high. Remember, a couple of trading sessions ago, it went to 58,000 and very swiftly back at around 60,000. But that dip is there today. In the last few trading sessions, the dip has got bought into. Let's see whether or not it takes place. I think at some part of the day, that dip does get bought into. But Prashant joined us finally. Prashant, welcome. It's a Friday morning. Tell us, how are you looking at the cues?
I mean, one day before the budget, right? And I think it's always interesting. I was thinking what happens on the budget. The market's going into the budget week.
Yeah.
Usually the month after the budget is also weak. But the day of the budget, and this is a Sunday, no FIs, no foreigners. Usually the range is, it can be anything between, I looked at the last nine budgets, including the two interim budgets. Range can be 1% to 4%, right? So usually
how many
the day...
How many downs?
By close.
Yeah.
I think more down than up.
Down.
Generally, on a lighter note, I think budgets are not good news. Have not been great news. Into the budget, post the budget, and on the day of the budget as well.
Just one more statistic with regard to that. When we go into the budget with a 3% cut in that previous month, normally I think some history is there, and I'll pull out that data, that more often than not, when you see a negative 3% get into the budget, then the following month at least is good. So clutching on to some good points of news.
Absolutely. Let's just, very quickly just add to what Rima and Nigel have said, right? And this is the thing, equities, gold, silver, everything saw one whiplash, basically a very, very big whiplash. Volatility is perhaps going to be the name of the game. When you have this kind of extended positioning, and that's the number on the NASDAQ, right? Sharp intraday recoveries. But when you have this kind of gold, silver, etc. will come up. Okay, let's just talk about oil as well, right? The other big cue, which is at $70 now, it slowly crept up. The general consensus view was oil is going to go down, more oil in the global markets, but will markets really do what, what consensus really tells us? Remember, weekends are always big, all the big events in terms of geopolitics, in terms of, military action, this, that, the other, have all happened on weekends. If you just go back and see the last one plus year, Iran has announced military drills. There's a big build-up around Iran, US build-up around Iran, and I think markets are nervous. So 71 on oil. So gold and silver, and perhaps, what we saw last night, it's not the last time we'll see something like this because positioning is so overextended. Any small bit of nervousness, and I think the nervousness came through after the tech earnings, etc., and the sharp fall in Microsoft, but it kind of spread through very quickly. And that's the function of overextended positioning. So gold low was 5,100, by the way. So $500 fall intraday. Silver fell from 122 to 106. Tech earnings, Apple Q1 seems to be strong. iPhone numbers are strong. Microsoft, Meta, Rima mentioned all that. There's a Wall Street Journal report. Amazon is going to invest up to $50 billion in OpenAI. More deals on the AI side. President Trump, FT says, will announce his nominee for the next Fed chair tomorrow morning, our time, which is basically tonight, our time, and US time tomorrow. So this time tomorrow, we perhaps will know who's his pick. There are two people in the race broadly. And he repeated the same thing. Interest rates should be the lowest, and we should be paying the lowest in the world, etc., etc. Nifty yesterday, and this has broadly been the call as we came into this week, that, again, overextended positioning in India on the negative side, and there is perhaps room for a bounce. And that bounce has played out, 370 points in 3 trading sessions. So we are now, by the way, we are out of the falling channel. It's a very steep channel. So I think we'll just work around and put numbers around the channel. So the next resistance is the low of 12th of January, which is, by the way, also a touch point on the channel. That's the low. That's the next resistance. 25,473 is that number. So it's very nearby from where we are. We should not fall below 25,295 now. Because the channel is downward sloping, the numbers also, the supports also are lower. 25,295 is that number. For the Nifty Bank, we are, we've been around the 20-day, playing around the 20-day for a while now, 59,589, and we are slightly, I think, above it. But we'll have to, I guess, give it one more day, 2 more days to figure out where we are headed. Rupee hit a low yesterday of 91.99. Offshore, of course, has already hit 92. And dollar index is up 1/3% this morning. Now, rupee is fallen when dollar is down. Okay, will it fall when dollar is up? It seems like we're kind of in our own rhythm with little to do with the global, the bigger, broader dollar in that sense. So keep an eye out on this one as well. You need stability more than anything else at this point in time. We have Ed Clissard, he's Chief US Strategist at Ned Davis Research, joining us. Ed, good morning. Good to have you with us here. Thanks for joining us. This big whiplash we saw, you think we'll see more of it, Ed? And what's your sense?
Yeah, we've had so many parabolic moves in lots of different asset classes, not only within certain equities, but in the commodities markets. And this is a sign that really this has nothing to do with fundamentals. This has everything to do with momentum traders, and they're chasing whatever the next trade may be, reacting to geopolitical news, which tends to reverse very quickly. So I think volatility is probably here to stay in a lot of different parts of the market, as long as we're trying to get a handle on things like what economic growth is going to be, what the new world order of trade is going to be. Some really big questions that probably aren't going to be answered anytime soon.
Ed, hi. Thanks for joining in. This is Rima here. So Trump just said that he will be announcing the new Fed chair Friday morning. So we've got a few hours to go, pretty imminent. The race, at least, is between Kevin Warsh, Kevin Hassett, Christopher Waller, and Rick Ryder. But who is your bet, and how will the market react in terms of the long-term trajectory for bond yields, Fed independence, etc.?
Yeah, well, it seems like that the betting markets, I believe, are looking for Warsh. But I think that the main thing is that Trump really has been emphasizing he wants to have a say in what interest rate policies are going to be. And his concern is that the new Fed chair would do what Powell did, is once that person got installed, that they're going to focus on the Fed being independent, which is what they're supposed to be. Now, on average, during the first 6 months after a new Fed chair, the Dow experiences a 15% correction. So in general, the market will test the new Fed chair. A crisis will pop up. It could be anything. That's a crisis. We don't know what it is ahead of time. But it's very possible that it's going to be about Fed independence. If you get some hot CPI reports, we're going to get some good economic data, I think, in Q1, because the one big, beautiful bill is going to boost tax returns in the U.S., and so you could have this battle of whether or not the new Fed chair should be pushing for lower rates. And that could lead to some consternation in the market until maybe perhaps the market dictates that the Fed will need to remain independent. You just may have to have some volatility before we get there.
All right. Hi, Ed. Good morning. Good to see you. Ben, as you said, history suggests we normally get a correction post the appointment of a new Fed. Hopefully, the mother market holds up this time around. But let's talk about what we do have on hand. The economic data that's coming out of the United States. How do you see things panning out there? Are you factoring in a recession at some stage? And the second factor is, the earnings in the United States has been pretty good, though the markets are quite expensive out there. Do you see the number of beats actually coming down, a bit of a slowdown with regard to that earnings growth? So, take us through both those points, earnings and economic data.
Sure. Let's start with the economic data. As I mentioned a second ago, growth should be pretty good in Q1 because we're going to get a bump in consumer spending. Almost everyone is going to get a larger tax refund when they file their federal taxes in the next couple of months. Now, from there, consumer spending growth could slow. So the trajectory for the U.S. economy is really driven by two things: AI CapEx investment in the high-end consumer, which is really driven by financial markets. And so that's the real challenge, is that the lower 80% of consumers aren't really in a position to grow their spending all that much. So we think once the one big beautiful bill bump kind of fades, growth will slow in the second half. Now, corporate America has done a fantastic job navigating a tricky environment with tariffs, with inflation. We've seen the beat rate percentage of companies exceeding expectations. The S&P been above 80% the last few quarters, which is historically very high. Now, Q4 earnings season just got started. Less than 20% companies have reported, but it's dipped into the mid 70s. So I think we're kind of past the really good news of companies managing tariffs. From here, it's going to be about productivity gains and incorporating AI into their workflows, which is probably a long-term trajectory. So we kind of wonder if earnings growth this year may be kind of high single digits, whereas right now the expectations are for the high teens. So we could get some earnings revisions, which could be part of a pullback in the market a little bit later in the year.
Thank you very much for joining us and staying up late. Great chatting with you. All eyes will be on the announcement of the new Fed chair. Just a couple of months back, it was Kevin Hassett who was the front runner, but then Trump himself said that he would like Hassett to be where he is, effectively clearing the way for Kevin Warsh to be the front runner. Betting markets are putting the odds at 80 to 90% for Kevin Warsh, and he in the past had served as the Fed governor from 2006 to 2011, and he was also in the reckoning when Trump had appointed Powell as the governor. So all eyes on that. That's going to be the big event. Get into a break, but we have lots of stock-specific action to track today, and we'll get to it in just a bit in our special Top 10 segment. We're looking at ITC, Tata Motors, commercial vehicles, Vedanta, Dabur, Dixon Tech, Voltas, Aurobindo Pharma. These are stocks with positive news flow. And the stocks with negative news flow are Swiggy, Manappuram Finance, and one stock where the performance has been mixed in Q3 has been Paytm. Welcome back. It's a busy Friday morning and lots of stocks will be reacting to earnings. So let's get straight to it. This is CNBC-TV18's list of top stocks for the day. Our entire research team is standing by after having worked pretty much the whole of yesterday evening and perhaps early morning. Guys, thank you very much for joining in. Good morning. Manglam, let's start with you. ITC.
Well, ITC, the results are very good. Strong performance in their core businesses, both the FMCG and the tobacco business. But all eyes will be on the impact of, higher taxation on tobacco and how volumes go out going forward. So if you look back, the numbers are incredible. If you look forward, it is uncertain, and which is why I expect the stock to open in the green, and perhaps after that we may see some bit of sell-off. What's good? Cigarette volumes up 6.5% versus expected 5 to 6% growth. FMCG, that was the start of the show. Revenue up 11%. The street was expecting 7 to 8% growth, and even the FMCG EBIT grew 42%. The street was expecting a contraction out there in the margins. The margins actually surprised positively by increasing 160 basis points. Paper and agri did not do too well, but then again, the street does not ascribe much value to these businesses anyway. All in all, decent numbers, see green, but there is uncertainty, the cloud of uncertainty, which is why the stock itself is lower by almost 20% this year so far.
All right, Mangalam, thanks a lot for that. Well, Rima, tell us about Tata Motors CV.
Well, good numbers. Revenues grew by 17%. Margins in double digit for the 10th consecutive quarter. And this quarter, margins expanded by 30 basis points to 12.7%. Volume growth is strong. Domestic volumes up 18%, exports up 70%. And in the domestic CV business, the company's market share went up by 100 basis points on a quarter-on-quarter basis to 35.5%. And the management says the demand to further strengthen in CV across most of the segments. So good numbers coming in from Tata Motors' CV business. What about Vedanta?
Well, Vedanta's been on fire, and the numbers actually were very, very good. The EBITDA number on the consolidated basis was up more than 30%. The aluminium segment, that's the one that led the way with the beat. The Q4 numbers as well will be even better. But the other segments, well, they're more or less in line. The other good point was that the net debt number on a sequential basis has pulled back. And given that they have sold some stake in Hindustan Zinc and they're generating a lot of cash, that is likely to be well undercover. Currently, net debt to EBITDA at around 1.2 times odd. What was good about the aluminium business? The aluminium EBITDA per ton at around 1,268. That's the best ever. The aluminium EBITDA actually was boosted by the fact that LME prices spiked and the cost of production was lower. The next quarter, I'll tell you what, from around $1,268 per ton, it could move to around $1,500 per ton, which is brilliant. On the demerger, the management says entire process will be completed by May 2026. And Nuvama, they've gone ahead, they've increased their estimates on aluminium prices, and that's why they've increased their target price to around 899 from around 806. Expect the stock to open up in the green, but I think there could be an element of profit taking that comes in during the course of the day. Do note we'll have the management in just a bit. In the next 10 minutes or so, we'll be joining in to detail those numbers. Going back to Mangalam though, Mangalam, tell us about Swiggy.
But Swiggy, you know, if you look at it, these numbers are pretty much in line with what the analysts expected, pretty much in line with what the company had guided for as well. And they've held on to their guidance. But if you look at it in comparison to, you know, Eternal, these numbers look slightly underwhelming. And that is what explains the sort of market cap and valuation difference between the two as well. So B2C gross order value grew by about 49%. The street was working with a 48 to 50% range out there. Food delivery, GOV up 20.5%. The street was expecting an 18 to 20% growth. That has accelerated. And margins out there improved as well from 2.5% to 3%. But Instamart out there as well, the business doubled, and on a net order value basis, it increased by about 76%. Contribution margins as well from a negative 4.6% came down to negative 2.5%. If you look at it in comparison with Eternal, you know, Eternal on a much higher base grew food delivery by 21.3%, quick commerce by 121%, have double the number of dark stores, a little more cash than Swiggy as well. While they've reiterated all their guidance, they've also said that they will consciously choose not to participate in deep discount-driven, purely volume-driven focused growth in quick commerce. So that may impact growth for their business going forward. But on the whole, it may be a bigger positive for Eternal than it is for Swiggy. So I'm seeing mild red in Swiggy, a bit of a green on Eternal today after the gash that we've seen on Eternal as a stock.
Thank you. CLSA has downgraded Swiggy to a hold, cut the target price to 335 post numbers. Gaurav is now joining in to tell us more about Manappuram Finance. Gaurav, how did the surge in gold prices affect the numbers?
Well, as if you look at Manappuram Finance, the gold business is actually doing well for the business, but it is about the other businesses which is actually dragging the earnings. So, because if you look at the numbers, now net interest income that declined by 13%, PPOP, which is pre-provisional operating profit, is down by 30% on a year-on-year basis. Now, both these numbers were in line with the street's expectation. What actually is a bit negative is that the credit cost. Now, provisions, they declined, but at the same time, profit after tax declined almost by 14%. It was a bit lower than the street's expectation. What it converts as margin number and credit cost. So when we look at net interest margins, now they are down 1% point from 12.5% to 11.5% just in a quarter. But it was actually expected by the street because the gold yields are actually falling across the industry. Credit cost, now that declined by 40 basis points. Street is expecting 70 to 80 basis point of decline in credit cost. That is something where we are seeing a bit of a pinch of salt for the results. And specifically, if you look at the MFI segment, there also we saw credit cost was still elevated. Now, management said that the elevation of credit cost will decline at a slower pace, and at the same time, even if you look at the housing finance business, the gross NPAs, they inched up from 3.1% to 4.9% significantly. Now, going ahead, what management is expecting is that the growth will be back in the vehicle finance and MSME book by FY27, but brokerages, they are not taking it in a very positive way because Jefferies, while maintaining hold, said that the profit should be under pressure because of the certain aspects of the business, and that is the reason why going with red with Manappuram Finance today.
Got it, Gaurav. What about you, Mangalam? Tell us about Dabur, largely in line?
Well, Dabur was absolutely in line, and the street was prepared for that as well because the Dabur's third quarter update that came by told you that the revenue would be slightly higher than mid-single digits, and that's exactly what the company reported as well, 6% revenue growth. So 3559 crore on the top line, the street was working with 3560 crores. EBITDA, 734 crores, the street was working with 733 crores. Net profit, 554 crores, the street was working with 562 crores, but there is an element of an exceptional of 15 crores. So you add that back, everything absolutely in line. The only fly in the ointment, the domestic volume growth, that came in at 3%. Street was working with 4 to 5%. But here too, home and personal care business grew in double digit. That's a positive. Healthcare grew about 2.7%. Oral care actually grew in double digits. So that's a positive as well, especially as compared to the flat performance that Colgate reported. So all these factors should say some mild green for Dabur. But the mood on FMCG is not very, positive over the last few trading sessions. So let's see which way the stock goes.
Okay, well, thanks very much, Mangalam, for that. Let's talk about Dixon and Voltas, which are next. And Upasana's got details here. Upasana, morning.
Good morning. First up, let me start with Dixon. Overall, largely in line set of numbers. A weak quarter was expected by the street. Now, revenue and margin was largely in line while PAT was above our poll. This is mainly because due to an exceptional item. Now, mobile revenue saw a growth of 5% on a YoY basis versus the degrowth that the street was expecting. And overall, if we look at the margin profile, margins expanded across segments between 10 to 130 basis points. Now, company has also mentioned in its con call that the Vivo PN3 approval, it is expected soon, and even the ECMS approval for camera and display module is expected shortly. Now, coming to the numbers, revenue has seen an uptick of 2%, EBITDA up 6%, EBITDA margins up 20 basis points at 3.9%, and PAT up 68% on a YoY basis. Now, coming to Voltas, it's a mixed set of numbers. Revenue below, margin above our estimates, while PAT is largely in line with our poll. Now, revenue fell by 1% versus the estimates of 2% YoY growth, and UCP is where the growth lies. Now, company has outperformed and positively surprised in its UCP segment with a revenue growth of 9% on a YoY basis. And if we compare it with Blue Star, it reported a UCP degrowth of 1%. So overall, if we look at the numbers, they look better than Blue Star. So going with a green with Voltas.
Got it. Thanks, Upasana, for that. Gaurav, coming back to you. Paytm?
Well, Paytm, if you look at the numbers, actually number tell the story, and those numbers are actually in line with the street's expectation. Because if you look at the revenue, that is up almost by 20%, 6% up on a sequential basis. And this was specifically led by higher payment GMVs, merchant subscription, and across the segment, we saw this growth. If you look at the expenses bit, that was a bit slower, and that is the reason why the contribution margin now they have expanded almost by 447 basis points on a sequential basis. Now, what is happening is that if you look at the other indirect expenses, we are seeing some kind of fall there because of the ESOP cost, which is coming down, and the marketing cost, that is also down. And that is the reason EBITDA growth was again in line with the street's expectation. Although EBITDA number, that is not comparable on a year-on-year basis. On a sequential basis, we are seeing 22 basis point of increase in EBITDA. Now it stands at 7%. Lastly, if you look at profit, there also we saw around 7% growth on a sequential basis. All in all, inline set of numbers. But what was important in this call was that the company has clarified that they have earned around 200 crores of the PIDF incentives till December 2025. And given that the PIDF incentives will not be there anymore, company said that they plan to offset it with higher revenue and targeted sales. In fact, during the con call also, they remained very positive. What they're saying is that industry will welcome all the initiatives, but they have clarified that the business model is not dependent on PIDF or any kind of other grants to that sort. And at the same time, they are very confident that the business will remain positive. They are strictly in the business of payment and financial services, as the company quoted. And lastly, they are also saying that they will bring back the wallet business. So all in all, numbers were in line, but the commentary was very positive for Paytm for the con call so far.
Thank you very much for that. Ekta, it's over to you for Aurobindo Pharma.
Well, yes, long-awaited news which has come in for Aurobindo, where the DGFT has imposed a minimum import price on Pen-G 6-APA amoxicillin, which is basically for the manufacture of antibiotics. Now, remember that Pen-G is used to manufacture 6-APA and 6-APA is used to manufacture the antibiotic amoxicillin. And currently, Indian companies import majority of the 6-APA. Now, Aurobindo has a capacity to manufacture it across the entire value chain and is the only Indian company with a Pen-G plant. So what this does is that it protects Aurobindo's production in terms of the minimum import price. The new MIP levels, penicillin G is at around $24, amoxicillin $30, 6-APA is at around $37. Now, remember that they have a PLI plant which was inaugurated in 2024, 15,000 tons in terms of capacity. It's operating at around 50%. It can go up to 75% with this news and can add at least as much as 600 to 700 crores in terms of EBITDA upside in FY27, FY28 for Aurobindo. So positive news coming in for them.
Thanks a lot for that, Ekta. We'll keep an eye out on that particular name. Well, let's turn our attention to Vedanta. The company, as I said, reported a steady quarter in December. The revenues were up, the profitability as well was up, and the debt went down. To detail the past quarter's numbers and give us a sense about how the commodity market is shaping up, the Group CFO at Vedanta, Mr. Goel, joins in on the show. Hi, Mr. Goel. Good morning, and always good to have you on the show, sir. Let's start off with the basics first. What's the outlook on the aluminium business? With regard to the cost of production, which has come down substantially, is there more room to go? And the outlook on LME prices as well. Please go ahead.
No, indeed, good day, Nigel, and good day all. And in fact, in multiple respects, the third quarter just gone by, has been a defining quarter for Vedanta. Aluminium in our portfolio right now is our single largest business. And you're right, our cost of production is almost $1684 per ton, which has came down by almost 10% YOY basis. From here, we do see in the near future, as in the fourth quarter, it will come down by another $150 odd or so. So our COP will keep going down. In terms of pricing outlook, right now, there's a global deficit in terms of demand and supply. The demand, in fact, is quite accelerated, and the supply will take time to catch up. So it is a demand-led pricing. We do foresee that the pricing will remain elevated in near future. So both the levers, the pricing and the cost, are favorable. In that case, aluminium margin can touch about $1,500 per ton in the fourth quarter.
Oh, that'll be brilliant. If you can get to around $1,500 per ton on the aluminium business. But let's talk about the other vertical besides aluminium as well as zinc. Oil and gas. That business, well, it's been moving, in a bit of a range in terms of EBITDA. It's been ballpark around 1,000 crores. When do you finally see some kind of ramp up on the oil and gas business?
I mean, Kane, in fact, is our third largest business. You're right, almost 1,000 crores remains the EBITDA in case of oil and gas. One very important point to underscore that oil and gas also brings a bit of factor of diversification in the portfolio, where the Brent pricing is not linked to LME, and hence it provides a bit of a linearity and tangibility in terms of earnings. The cane volume is one area where the entire management is focused singularly. Almost 90,000 barrels per day is right now the production. We foresee this number going to almost 120 or so in 6 months' time. Critical point to note in this business remains if we get more discovery and if we can explore more, this business has significant potentials.
Mr. Goel, you seem very well placed in this entire melt-up scenario that we're seeing globally. Higher prices, cost as well going down. So that's good on you. The big question is, though, you're throwing off so much of cash. What do you do with it?
I mean, our focus, in fact, remains singularly in terms of basics, which is the volume augmentation, cost compression, and focus on cash generation. So Vedanta's cash conversion from EBITDA is almost 50%, if not more. So in the current year, we'll generate more than 3.5 billion free cash flow pre-growth capex. Now, with the cash flows, the single biggest tool with the company remains allocation of capital. So we intend to invest the money for growth in terms of growth capex, almost 1.5 billion in next 3 years' time, every single year. We also intend to reward shareholders through dividend. And Vedanta has been India's largest dividend-paying stock. And finally, deleveraging. Net in the current fiscal with the free cash flows and the zinc offer for sale, we are looking at almost $1 billion deleveraging in Vedanta as a group. In that case, Vedanta India's net debt to EBITDA that we closed at about 1.23x in December will come down to 1x. And 1x leverage remains a benchmark in India and the world over in metals and mining.
Well, that's been a good positive, actually, with regard to deleveraging both at the parent as well as at the listed company level. But the street sometimes a little bit cautious about Vedanta Resources. The debt, yes, as you said, has reduced by around $4.5 billion in the past few years. Earlier, you had guided that number comes down to around $3 billion. On course?
No, that's correct. And you're right. The VRL debt from almost 10 billion has gone down to 4.5. It is a decade-low debt. And our commitment and the VRL has been 3 billion reduction over 3 years. So VRL debt will go down to 3 billion or less than 3 billion over next 3 years' time organically.
All right, Mr. Goel, we take that on board. But the street is a little bit cautious on Vedanta. Sometimes you'll get very, very adventurous. Like you all thought the Jayaprakash asset was very, very strategic fit. But the street actually thought otherwise. Basically, is Vedanta looking at any ambitious inorganic growth?
Action speaks louder than the words. If you look back last 3 years, debt at Vedanta Resources cut down from 9.1 billion down to 4.5 billion. At Vedanta India, leverage from 2.1x down to 1.2. It will further go down to 1x as we close the fiscal. So deleveraging remains our single biggest priority. Rest all priorities will be subservient to that priority. So there's no reason to be nervous. Vedanta will continue on the path of deleveraging in near future.
So in passing, you mentioned about that Hindustan Zinc OFS. Could you tell us what is the targeted holding that Vedanta Limited has in Hindustan Zinc? Do you all want to pare it down further?
Hindustan Zinc Limited right now by far India's most valuable metal company with a market cap of more than 3 lakh crores. Our position in the past has been quite clear that in Vedanta, we intend to retain more than 51% majority, so mathematical majority, so we don't need to sell more. In zinc, we don't have a target, but over the last couple of years, we have been liquidating. I think our holding will remain in the same vicinity. With the demand and the pricing, some more liquidation is strategically possible, but right now, nothing on the table.
The final question then, sir, on demerger. When do we see the 5 listed entities of Vedanta Limited?
We intend to make 1st April at the date on which demerger becomes effective. Thereafter, it takes almost 6 weeks' time to get things listed. So between 1st April and 15th of May, all Vedanta companies will get listed. One Vedanta becomes 5 Vedantas in first quarter.
Always a pleasure talking to you, Mr. Goel. Wishing you and the team all the very best. The last quarter was good, and going by what you're saying, the next quarter will be spectacular. Thanks a lot for joining in. Well, time to slip into a short break. Up next, the management of GE Shipping is waiting by to break down their Q3 numbers. Don't go anywhere.
GE Shipping is with us. They've reported a strong performance both sequentially and on a yearly basis. The company saw good revenue growth of 18%, strong margin expansion in the third quarter. G. Shivkumar is with us, Executive Director and CFO at GE Shipping. Mr. Shivkumar, good to have you with us here. Thank you very much for joining us. You know, we can get into the numbers and your guidance in just a bit, but oil's at 70 and all this build-up around the 3 talking points, the current business landscape, spot rates, and impact of geopolitical tensions. I think I'll start with number 2, impacted recent trade deals, of course, also a case in point. So, Mr. Shivkumar, let me just start with the point about what's happening around Iran, which is all this build-up and oil's gone up $10 very quickly. How has that impacted spot rates, if at all? And let's just start there.
Morning, Prashant. Thanks for having me. The Iran buzz hasn't yet impacted spot rates really. Venezuela did impact in a small way because some of that trade which was carried on sanctioned on what we call the dark fleet has now become legitimate trade. There are international oil traders actually bidding for Venezuelan cargoes and taking in ships to move those cargoes from the open market. The Iran hasn't had an impact on tanker spot rates yet.
Sir, could you tell us how much higher are the spot rates as of today versus, say, 3 months back, in the average of Q3 versus average of Q2 and average compared to last year?
Yes, across the board, rates were better Q3 versus Q2 and Q3 versus the corresponding quarter as well, in different degrees. So Cape sizes were probably better by $5,000 to $7,000 a day. This I'm talking about spot market rates. Product tankers probably $2,000 to $3,000, while crude tankers, so Suezmax crude tankers were probably up $10,000 plus a day. Aframaxes also were up maybe $5,000 to $10,000 a day. So it's been mixed. So the 9 months period versus 9 months of previous year, it's about the same because we had a very strong start to FY25. So Q1 FY25 and to some extent Q2 were very strong. We've had the opposite here. We had Q1 and Q2 fairly weakish. And now we've had a strong recovery in Q3, which continues so far into Q4 for the tanker markets. And dry bulk, I must point out, is unseasonably strong. This is traditionally the weakest quarter in the year, but it's been really strong and unusually so.
That's interesting. Mr. Shivkumar, you expect this current situation around the Strait of Hormuz to have an impact on spot rates? or no?
Currently, there's nothing really happening around the Straits of Hormuz. There's a lot of talk. What can happen is if there is a closure or if there is, if something dramatic were to happen, the headline impact is not good because so much of oil moves through the Straits of Hormuz. 30-40% of global tanker trade happens through that. That would be really bad if for some reason oil couldn't move through the Straits of Hormuz. And then your oil price, then the oil price starts to matter.
So you mean it'll hit demand, there'll be demand destruction, and hence it'll be sort of that percolates down as lower
It's directly to tankers because less cargo which is available to move. Let's say that oil just gets cut off from the market. That's less oil for tankers to carry, which is straight away demand destruction for tankers, other than flowing through, consumer demand, etc.
Sir, in the past, you've said that, the prices are very high, which is why you've refrained from buying some of the new ships. But what if prices continue to remain high? What is the strategy in that event? Because at some point, then your inventory, the ships that you have, are going to be very old and aged.
Yes, that is a question which troubles us all the time. What we have done is we've done a lot of transactions in the last 2 years. While we have not increased our capacity, we have replaced the old ships. As ships get closer to age 20, which makes them less tradable in the international market, we have been getting out of those ships and replacing them like for like with similar ships which are younger, which can trade in the international market. So while we don't want to commit additional capital to capacity expansion today, we are committing some incremental capital towards maintaining our capacity and replacing ships that are aging out so that we can maintain our position in the international markets. So that's what we're doing. We've been through this before. We've been through a super cycle in 2003 to 8. And we saw how that ended when people bought ships towards the end of that cycle, that you did badly. And we know that patience will eventually pay off in terms of the returns that you make from the good investments that you make in the low part of the cycle. So that's what we're waiting for, really.
Got that. I know it's early and it's a very volatile world, but do you think, broadly speaking, it's a FY27 is how is it looking as we sit now at the beginning of this year?
It's really tough to call because geopolitics it has been so uncertain, right? And even if you can call an event, you don't know how that event is going to affect rates, whether up or down. And that's why we are prepared either way. We've got 30 plus of our ships open in the spot market if markets are strong. And we have the ability to buy a lot of ships if the markets go down. And that's the best you can do. You can prepare for the markets. You can't predict how these markets are going to play out. You can prepare for those, for whichever scenario pans out.
Just referencing back to that super cycle of 2003 to 2008, which ended badly. I presume we are in a super cycle, and if yes, where are we in that stage?
We've been in a very strong tanker cycle for almost 4 years now. It started with the Russia-Ukraine war, which started in February 22. So we're coming up for 4 years now of strong tanker markets, which is unusual. A super cycle is very unusual for the markets. Typically, these up cycles last for a year to 2 years. So we've been now for 4 years in a very strong market. So that's the extent of the cycle that we've had so far.
Just one last question, Mr. Shivkumar. Budgets around the corner, and I think shipping will find a fair bit of mention, though it's about shipbuilding, especially on the commercial side, etc. You, of course, are a carrier in that sense, but any implications if there is an increased amount of thrust on shipbuilding on the commercial side for you?
No implications for us if anything happens in shipbuilding. So we would welcome, as I've said before, we would welcome focus on shipping as an industry. No real implication for us. We look forward eagerly to some incentives, but otherwise it's business as usual for us.
All right,
and shipbuilding incentives don't really affect our economics.
Got that. Thank you very much. Appreciate you joining us, and good luck as we look ahead. As you said, I mean, it's up and down in large ways, and that's largely geopolitics. So tough to call FY27, but so far, so good. Thank you. Well, I think copper is the other one, right? I mean, we've been talking about oil with G shipping. We've spoken about gold, silver, the big whiplash, etc. But copper moved big time last night. Manisha is here on the phone line with that. Manisha, morning.
Morning, Prashant. Thank you for that. Well, yes, 10% of gain. I mean, it's the first time ever that you've seen that kind of a gain coming in. The last time that there was a short call or a buying coming in copper, this big quantity was in November 2008. So, I was reckoning that which people prices are. But more than anything else, this is the retail buying, institutional buying, banks and funds buying, which is keeping the copper prices higher. Well, most banks and brokerages will tell you that this is not sustainable. I mean, 10% gains in copper in an overnight market with demand in China not really sustainable. This seems like more like a speculative activity. But this is, the copper is Dr. Copper. This tells you it basically is treated as a barometer for global economy. So when a commodity starts to behave like that, there are concerns across banks that I'm speaking to. So while we have seen $14,500 a ton on LME, in the U.S. market, we are trading at an all-time high of $6.5 a pound there. And this is happening at a time when there is copper excess at 900,000 tons in the global markets. So whether it is about LME, Shanghai or US, the copper inventories have been increasing. So it's not that the current copper is in shortage in any sense. So this does seem like speculative, but 10% of a move in copper in a matter of 3 hours is unheard of.
I don't know what is following what, right? Hindustan copper was up 20% yesterday. And copper is up 10% in global markets. I mean, it's just, as you said, I mean, it's the real guys with physical need for copper, not the financial speculators, of course, I mean, would say it's unsustainable. But right now, it seems like a bit of a frenzy across commodities, and copper is very much part of it. We'll take a quick break. Manisha, thank you very much for that. We'll leave you to it. We are back with the big movers with Hormuz from yesterday. And what moved with volumes, and that's what we want to focus on. Shrikant Chauhan is going to be with us. Sudeep Shah is also going to be with us, and they're going to run us through trades you want to take this morning.
Welcome back. Let's talk about the rupee. The rupee hit a historic low, closing at 91.99 against the US dollar. Now, speaking on the currency fall, the chief economic advisor says the rupee is not an outlier. Listen in to what he had to say when asked on the impact of tax swaps on the rupee and the FPI flows.
Let's talk about the fact that, as you point out in the survey, the fundamentals of the economy continue to be strong, yet we've seen a significant depreciation of the rupee. You still believe that the rupee is not an outlier if you look at a longer-term horizon as far as the currency is concerned. But in your words, when we talk about investor reluctance and you call for an examination of that, is there anything in specific, any specific friction, pain point that we can address today to ensure that we start to see capital flows? FPIs, for instance, will it make sense to address tax-related issues at this point in time, or do you believe that that won't really move the needle much?
No, whether it will move the needle or not is not exactly in our control. But I would agree with the first part of your statement. We need to do whatever is in our limit, is in our capability to be able to do, which is to offer predictability, continuity, and stability of policies, whether it is tax or non-tax. And also, in terms of, we are doing that in terms of improving our geographical market access. If you locate in India, where all you can sell. I think we are expanding our geographical footprints by concluding free trade agreements. So whatever you mentioned with respect to policies, tax or non-tax, offering that predictability and continuity is desirable in and of itself. Now, whether that will guarantee an outcome, that is not in our hands. And that has never been the case, because a lot of other considerations influence investors' behavior. But if we keep doing whatever is in our remit to do so, I'm sure investors will take note of that. And in comparison to other nations, we will come out looking better, and naturally money flows will follow.
Okay, all right. It's that part of the show where we focus on the high volume stocks, and some of them were backed by delivery. Harmaz joins us to give us that list. Hey, Harmaz, morning.
Morning, Nigel. And you spoke about copper in closing yesterday, and Hindustan Copper. We've been speaking about this over the last couple of days now. There's a 20% up move on the stock yesterday, and it was continuing for the second straight day among the top traded stocks on the Nifty 500. The fourth straight day of gains, and in these 4 sessions, the stock is up 40%. And almost 14 crore shares were traded yesterday, 20-day average of around 5 crore shares. And trading volumes yesterday, the turnover was over 10,000 crore rupees on Hindustan Copper. However, only 15% of the total number of shares that were traded were marked for delivery. So 2 crore shares for delivery, 20-day average of around 92 lakh shares. And the stock is seeing the best start to the calendar year since 2012. It's up over almost 50% now in the month of January. On the downside yesterday, a 5-star business finance was one earnings reaction, the biggest single day drop since October of 24. The top loser on the Nifty 500 on yesterday. Volumes yesterday were the highest in 3 months. Well over 1 crore shares were traded, 20-day average of less than 7 lakh shares. And out of those 1 crore shares, 35 lakh shares were marked for delivery, the 20-day average being just over 3.5 lakh shares. And courtesy of yesterday's fall, the stock has now slipped below its IPO price, which was 474. And lastly, the stock that is actually seeing proper delivery buying has been Axis Bank. This is the third straight day of gains for the stock yesterday, ended at the highest point of the day as well. It's up 8.5% now in the last 3 sessions, and over 1.5 crore shares traded yesterday, 20-day average of 70 lakh shares. The volumes yesterday's trading session were the third highest in the month of January, and delivery-based buying yesterday with almost 1,600 crores taking place in Axis Bank yesterday. There's over 1.2 crore shares that were marked for delivery, the 20-day average of around 45 lakh shares, and the stock doing well, ended at a 52-week high too.
Thank you very much. For that, we will slip into a very short break. We'll come back with the pre-opening rates. We'll also be joined by the management of Arvind Fashion to discuss the Q3 numbers. We'll also connect with Shrikant Chauhan of Kotak Securities and Sudeep Shah of SBI Securities for some technical trading ideas.
2 minutes out for the market pre-open session to kick off. Shrikant Chauhan is with us, and we also have Sudeep Shah joining us with their take on where things are at. 370 points in the last 3 sessions, and we are out of this falling channel that we've been referring to. Can we do more? Or given the macro screen, which is actually pretty poor today, this morning at least, is there a bit of a pullback on our hands? Shrikant, you go first. What's the sense?
Good morning, Nigel and Rima. I just would like to share my observation that whenever we see rally in crude and copper, we see equal amount of upward momentum in equities. And we need to see that how actually it gets pan out in coming days. But coming to the business, I think Nifty is in the range. It is certainly going to find resistance at 25,500. Today, in case before the budget, if we see the market is closing about 25,500, then it will have positive implications. As GIFT Nifty is indicating, if we see lower opening, then close to 25,300, we should look for taking some long bets in the market with a stop loss of yesterday's lowest level, which is around 25,150. So with a very near term, I mean to say with a view of day, 25,150 should be the final stop loss for holding any long positions. And 25,500 is the breakout level above which we can expect further more bullishness.
Sudeep, your Nifty call?
Good morning. See, what I feel is that post today's gap down opening, I feel markets would stay in a range between 25,150 and 25,500. I don't see them crossing 25,500 either or breaking 25,150. So closer to 25,230, 25,250. One can take small longs with 25,150 as a stop loss from a trading perspective, purely from an intraday perspective, and then go into the budget on Sunday.
Sudeep, you have done some analysis, right? When the getting into budget day, when the markets are soft, invariably, the next couple of months are good. If you could just give us that brief data point.
Yeah, see, what we have seen is that we have analyzed the past 15 budgets, and within that there has been 3 instances where the 1 month or 1.5 months going into the budget have been quite weaker. And on all those 3 occasions, we have seen Nifty as well as Sensex, they have delivered decent returns in the 1 and 3 months perspective. So that's why we feel that the current weakness from a positional perspective should be used to accumulate good quality stocks from a medium-term perspective and not from an immediate trading perspective, as the gains are not immediate post the budget day or in the next 1 week. But yes, 1 month and 3 month periods are quite good when the markets go into the budget with a weaker footing from a 1 month perspective.
Okay, got it. Let's go across to your calls then. Sudeep, you go first.
See, a couple of stocks on my radar. One is Naveen Flooring. Now, we've seen this stock delivering very good results in the past 2 quarters. And post that, the stock has traded in a range between 5,800 and 6,100. Here, we feel that the stock is on the cusp of a breakout. This can be bought with a stop loss at 59.30 on the downside and 6,400 on the upside. The other stock that is on our radar is Indus Towers. Now, here also we have seen a decent breakout with volumes, and we feel the stock can move to 460, 465 levels and can be bought with a stop loss at 428.
Shrikant, what about you? What are your trades?
So I would like to go with momentum, and in that specifically we like steel stocks. Most of these stocks have performed very well in last 2 days. But Steel Authority is still under consolidation mode, and if we consider its technical pattern, I think here also we can expect some more rally in the near term. We can expect 165, 166 sort of levels in the near term. We can keep a stop loss around 153 for buying Steel Authority. The other stock on which we are bullish is Bharat Electronics. Currently it is around 445, 443. Almost all the defense stocks should perform in today's date. That's my view. But yes, Bharat Electronics looks much stronger candidate to buy with the stop loss close to 434, and we can again expect on the higher side 465, 470 sort of levels.
Shrikant, stay with us. Sudeep, thank you very much for joining us. I just want to quickly take a look at how these stocks are opening, right? Maybe before we get into the next corporate interaction. Hindustan Copper, if you can put up. We just, Manisha was telling us that 10% jump in copper. Hindustan Copper was up 20% yesterday. Limit up. Okay, there's nothing on it. Let's refresh it. And volumes are, is it yesterday's? I am not sure. But the pre-open has started. And we should look at... the other area to look at, which will be interesting after the huge volatility, is all these gold and silver ETFs, right? So maybe a nifty, a silver bees, gold bees, and things like that, and take a look at where they are starting this morning in the pre-open as well. I think they're just, I think prices are coming in as the book is built in the pre-open. So we should give it a minute, 2 minutes more, and then we can come back. Shrikant, we'll wait for the prices to update, and you'll join us at 9:10, so we'll ask you then. But I think we have the management of Arvind Fashions with us.
Indeed. Arvind Fashion has reported a steady set of Q3 numbers, top-line growth of 14-15%. Margins have expanded. The company's added 24 new stores. In fact, the company is also confident about sustaining a double-digit growth trajectory. Kulin Lalbhai, Vice Chairman, Non-Executive Director at Arvind Fashions, is joining in. And on the screen, you will see what we'd like to discuss with him. Thank you very much for joining in, Mr. Lalbhai. Let me begin with your direct channel, which you yourself have said is the growth engine for the company. Now, direct includes retail, which is about 45-50% of the overall revenue, which saw a growth of 8.2%. And the other part to it is the online B2C sales, which is growing at 50% and is about 17% to the overall growth. So together, the direct channel is in excess of 60%. Will that continue? And if you can provide a breakup of retail and B2C, what kind of outlook do you have for Q4 and FY27?
Yes, I think the highlight for us this quarter is that we've had the highest growth that we have had year on year over several years. And what that is indicating is that all the work we have done on setting up the growth drivers, especially in the direct business, they are now showing fruit. So in a sense, just coming to your question, I think our retail business actually grew at upwards of 11%, and the online B2C grew at 50%, as you said. And these are two channels which are very strategic for us. So we feel as a company there is a lot of square feet we can add across our brands. We are adding close to 15% on our 1.3 million square feet every year. We've also had very strong like-for-likes. We've got industry-leading like-for-likes. So that was 8% this year. So if you see, our retail has a lot of growth drivers. And online is a business we are inherently very bullish about. We've been investing in that business for a decade. And our brands are going from strength to strength. So as we get into newer categories, as we go deeper into .coms and launching our .coms across the portfolio, we have several new growth drivers which are going to come in the online space as well.
Okay, and can you tell us what will given how fast online B2C is growing, 50% in Q3, current revenue contribution is, I think, 17%. What kind of growth momentum are you seeing? What could the contribution rise to? And what are the kind of margins that you make in this business? Because the cost of acquisition of customers is also very high and you're making investments here.
Yeah, so the best way to think about online is putting our online B2C and B2B together. That gives you a sense of the underlying growth, which is more in the 20 to 30% range. We are actually degrowing the wholesaling online and ramping up the direct selling. So as a combined channel, it's growing at 20-30%, which itself on such a large base, it's both put together, it's close to 27% of our company's revenue. That piece is growing very well. On a profitability, the good news is over time, we've really understood this channel very well and we've refined its profitability profile. So from a channel profitability perspective, it's the same or slightly better than some of our other channels. So change in channel mix is not going to have a major impact on our EBITDA. Our EBITDA growth is coming from operating leverage and improvement in our sell-throughs and gross margin profile as a business.
Yeah, okay. Kulin, hi, good morning.
Morning.
Just have a question. I mean, this relates to the overall dynamic and the worries that maybe this is past worries and future is brighter with the cyclical recovery, etc. But has demand taken a bit of a knock in some other, but all consumption related? We have seen, the general anecdotal feedback is that maybe demand has kind of come off a little bit. Can you tell us if that is the case or no, nothing at all?
See, at least for our apparel industry, I would say the last 5-6 quarters, we've had quite a lackluster kind of demand environment. In fact, I would say directionally it is positive. I think if you look at the series of actions taken, right, from income tax cuts to GST cuts and rate cuts, I think all of this is accumulating and our belief is in the medium term, it will be a positive. Our apparel industry, since it's a low ticket size industry, will not possibly see the very short-term uptakes that you see in the larger ticket size industries like automobiles. So I wouldn't say in the very short term, right after GST, we have seen a huge positive momentum. I would say that the momentum remains similar with a slight positive bias. And I would believe that over the next couple of quarters, the impact of all of these cuts should start showing in the consumption numbers.
Okay. Kulin, say next, again, not a guidance per se, but would you be able to give a, say, same-store sales growth guidance, or say over the next, directionally, what should we expect in the ballpark?
So we have said, our range of growth in current market conditions should be between 12 to 15%. The good news is we've been at the higher part of that limit. We've been a little ahead of our plans on growth. So I'm cautiously optimistic that, we should stay in that higher band that we are talking about. Our growth drivers are still kicking in. So I'm feeling quite optimistic, and our like-for-like, as you said, also has been high single digits, which is one of the industry-leading productivities growths in the business. So currently, we are set for being at the higher range of that range that we have given out.
Kulin, very quickly, there's a buzz that you're going to be acquiring a new brand. Is that correct?
No, I wouldn't want to, comment on that.
But is it possible?
Our core strategy is the 5 brands to scale them up. We want to make each of them multi-thousand crore brands. Our largest brand, US Polo, which is well above 2,000 crores now.
Yes.
That brand has grown on that base at upward more than 20% this quarter. So it's just showing the sheer potential of our large brands. So the core part of our strategy is to make these 5 brands bigger, bolder, and larger.
Okay, I hear that you're looking at a new brand, so we'll wait for that announcement if in case that's true and there's some conclusion out there. But the point on US Polo, as you said, it's a 2,000 crore brand. Now, on this sort of a base to keep growing, how confident are you? Because that's a bit of a worry, right?
So that's the point I was trying to make, that if you look at, say, a brand like US Polo, we believe our retail footprint is still severely underpenetrated. We are building bigger and better stores. We have so many new segments which are just emerging. Our footwear business has become a few hundred crores, but we think it can become much larger. Our women's business just got started a couple of years ago. Our kids and innerwear business franchises are just growing up. In online, it's become the largest brand with more continued momentum. Our .com, which launched a couple of years ago, is now coming to size. So I think in the India of today, we shouldn't have a mental model that 2,000 crores is a peak size or a very large brand. We feel very confident with our growth drivers that this brand will have this strong double-digit growth on such a large base.
And we we will chat again as you execute on that, and we hope that is the case. Thank you very much, Kulin, for joining us.
Thank you.
Really appreciate it. Shrikant Chauhan is with us, back with us. It's 9:12, 3 minutes to market open. Shrikant, your trades? I think you're on mute, Shrikant.
Yeah, sorry, Prashant. So we're looking at the opening of the market, which is lower by 170 points. I am of the view that after opening lower again, it should recover, and we need to focus more on momentum stocks, especially defense and metals. Despite there is a lower opening, we should look for taking some long bets on steel stocks. Along with Steel Authority, we also like JSW Steel, which is around 1250, 1255. There also we have view of heading towards the levels of 1280, 1290 in the near term. So it's a buy if there is a lower opening. We also like Hindustan Aeronautics along with Bharat Electronics. There also we have a target of 4800. And yes, we cannot forget buying any particular stock from the private banks. HDFC Bank was down in last 1 month, but currently it is rebounding from its important levels. So there also we can expect further more activity in today's date.
Got it.
And finally, last
Shrikant, got that. So steel, HAL, and private banks largely focus areas. Shrikant, I'll come to you. We're just hitting market open. Swiggy is what we're going to talk about. Mangalam is standing by. Mangalam.
Well, the numbers, by themselves, not a problem. But if you look at Zomato, then it feels fairly underwhelming and tells you why, Swiggy is 1/3 the market cap of Eternal as well. B2C GOV growing 49%, pretty much in line with street expectations of 48 to 50% growth. Food delivery growing at 20.5%, a lot better than their own guided band of 18 to 20% as well. And adjusted margins improving. So things are on the mend, but not just fast enough. On a lower base. So the street would have expected, because it's a challenger and a smaller company, would have probably grown a lot faster. Turns out not. On a higher base, Eternal has shown a much faster growth in their food delivery, quick commerce, and dark store expansion as well. Add to all of this, the company said they've consciously chosen not to participate in deep discount-driven, purely volume-focused growth for quick commerce. So that's something that will have a rub-off impact on all the other quick commerce players as well. But they've reiterated their guidance. The brokerages say it's a little difficult for the company to go ahead and meet that guidance. They've reiterated that guidance for contribution break-even in quick commerce for the first quarter in FY27. So that's just about 2 quarters from now. And at a time when they've done minus 2.5% in contribution margins as of now. So all these factors we will be tracking very closely, seeing some red on Swiggy, a little more on Zomato in terms of green.
5.5 lower on Swiggy, and we'll see. They don't want to indulge in deep discounting to push up volumes, but will there be a choice? Everyone is sitting on large amounts of cash, and one may push the other to do things they don't want to do. We'll see. Market open coming up, and it's down about 0.5, 0.6%, 25,245. You got the Nifty Bank, which is starting about 0.5% lower, 59,600. or so, yeah, so 59,600 or so. And you've got, what else? Nifty mid-cap is down about 1.25%. The small-cap index is coming up with a 1% cut as well. So across the board, it's lower. And 200 points is what that translates into on the small-cap space. 25,258 on the Nifty is what we have. The Nifty heat map coming up on your screen, and it is a sea of red. Asian Paints, Power Grid, Grasim, Titan, 4 names in the green, everything else in the red. Hindalco, Tata Steel, ONGC, some of the top-performing metal stocks are lower. ONGC had a big move yesterday. That is under pressure, although oil prices are up. 145 down on the Nifty. Rima.
Well, metal is the big drag today. The Nifty Metal Index is opened with a cut of near 4%, so profit booking after the meteoric rise. Hindalco, Tata Steel, JSW Steel under pressure. Eternal is losing in sympathy with Swiggy. Swiggy down nearly 5%, while Eternal is down close to about 2.5%. Earlier this week, Eternal had a pretty good rally, so some profit booking is also visible there. Eternal is still up nearly 4% so far this week, though year-to-date it's under pressure. Some of the PSUs are weakening in trade, so Coal India add that to the list. M&M has been the rank underperformer this week. M&M is down nearly 5%, and since the start of this year, M&M is down close to about 10%. IT is weak in trade. Again, maybe the Microsoft earnings, the stock price was down nearly 10%. Cloud business slowing down versus expectations could be weighing on HCL Tech, Infosys and TCS this morning. ITC numbers were fine. Actually, Q3 numbers were pretty good, but the street is concerned that how the excise duty hike effective 1st February will affect the future. So ITC has opened up on the flatter side. NTPC, Bajaj Auto report numbers later today, and both those stocks are seeing some amount of weakness ahead of that. Tata Motors commercial vehicle numbers look pretty okay. The top line growth of 17%. But the stock is down 3%. So Tata Motors commercial vehicles, I was reading a Motilal Oswal note, but according to them, margins have missed expectations, and plus the stock had seen a good rally since the start of the year. So some profit booking is visible there. On the way up, it's Aurobindo Pharma, which is the big star today on the back of the minimum import price on penicillin, which will support Aurobindo Pharma. According to analysts, there could be an EBITDA boost of a maximum of nearly 700 crore rupees, so pretty sizable for Aurobindo Pharma. Other large cap gainers include a Nestle, a Dr. Reddy's, Interglobe Aviation. BEL is one of the few defense stocks at fresh highs and very strong price action and volumes earlier this week, and BEL manages to open up in the green.
All right, the casualty of the morning actually is South Indian Bank because, the MD and CEO, Mr. Seshadri, he is, not going to be continuing his term. He's going to be looking to pursue activities of personal interest post the completion of his term, which ends in September 2026. So that explains why that stock, in fact, is getting slammed back. Bids down big time in today's trading session. The positive earnings reaction, though, has come in from Sirma. That stock, in fact, is up close to around 4%. So big move is what we're seeing out there. And Hindustan Copper, just take a look at that volatility. The low of the day that we're seeing on this particular name is 680. The stock is now at around 730. So massive move is what you're seeing in these metal space, but the metal space itself is not for the faint-hearted. You need to be prepared for these kind of moves. You've seen it on the upside. Now sometimes you'll see it even on the downside as well. So that's a bunch of stocks that are moving around. What else is in focus? Well, a few stocks. Actually, Walchand Nagar is up close to around 8%, moving on fairly good volumes. So that's bursting away on the upside. Cupid is another stock that's doing pretty well. That, remember, has seen a sharp correction from the recent peak as well. So after a while, the advanced decline ratio firmly in favor of the number of stocks that are declining. Close to around 1,900 stocks declining compares to around 450 stocks that are advancing. Let's see whether or not they can get closer to each other ahead of the big budget 2026.
Absolutely. And I think, we're just starting, so there will be more as we go through the motions of the first 5-10 minutes or so. And there will be reversals, and as there always is in that sense. So more in terms of stocks, etc., coming up. But Venugopal Gare is with us now. He's Managing Director and India Head of Research at Bernstein. Venu, good morning. Great to have you with us here. Thanks very much. A couple of very provocatively titled notes, Venu, I must say, last 2 or 3. And I'm sure they've been discussed. I can tell you they've been circulated widely. I mean, I think the EU, India, FTA, I think you wrote a note titled, Mother of All Deals, but for who? With a question mark. But I'm going to maybe come to that a little later because the budget is in front of us, right? And you said whether India needs another tax reboot. That, of course, was a note from the 23rd of this month. So let's just start there, Venu. And taxation is pretty much, at least on the equity side, what all the talk is this time around, perhaps apart from defense spending and how much budget capex goes up. So take us through your thought process on this taxation and whether you think we'll see something.
Thanks, Prashant. Firstly, on those provocative titles, I think market needs some excitement. I thought probably the titles might help create some buzz. So coming to the taxation part and the broader discussion on budget,
there has been too much excitement. Only it is on the downside. So you're going wow and whoa. We're looking at prices. I mean, so we need uppers here. I'm not sure your notes are uppers. We don't need downers.
Let's see if the budget gives me that opportunity. Probably do that. I have slightly higher expectations in terms of what the budget should deliver. Part of my thinking is that philosophically, we've reached a stage of fiscal deficit where there is no need to cut down fiscal deficit materially. My thinking is this: when inflation is low at this stage, it is perhaps a time, and when private capex is okay, I would say, but not like materially accelerating. This is a time when government should be still doing the heavy lifting. And more importantly, remember that a wage revision is also due, which is, of course, not this year, but within the next 2 years or 3 years, which essentially means that a fiscal space has to be created. Now, with nominal economic growth still in that 9-10% band, it is essential for the government to keep fiscal deficit higher. Now, normally this thinking is that if deficits are higher, market would be punitive, the yields could spike materially. I think my view is the government shouldn't worry too much about it. If you're able to do the right kind of spending and stimulate the economy, that probably is more important in the long term. When I say long term, it's a 12-month view to ensure that a lot of those parameters which people look at from a growth perspective or from a currency or other perspective will easily even out and normalize. So heading into this budget, I think a couple of things that government should do, as they're probably moving now into a debt to GDP sort of a category, it tells me that fiscal deficit is not going to be cut much. So even if you cut 10 to 15 basis point fiscal deficit over the next 5 years, so 4.5, let's say going to 4.25, going to 4.1 or whatever, you can still bring down central government debt to GDP from 56% to let's say 50% in 5 odd years. So this essentially means that there is room for government to still create some capex growth. That's number one. And my broader measure is 10% plus is what I'm expecting at the bare minimum for this budget. The second thing is that certain tweaks, especially around LTCG, is probably warranted. It's not a very large quantum, especially the equity side of things. Probably government could have bands a couple of years down the line. So if you have more than 3-year hold or 4-year hold, maybe have the differential, taxes. Similarly, to stimulate private sector, I guess, things like accelerated depreciation being reintroduced at an overarching level, even if you don't want to make it sectoral sleeve level, is another thing I'm looking forward to. I'm not expecting too much on consumption side of things. We've done a lot of things last year. And remember that GST impact of low collections will also be felt in this upcoming financial year as well. So that's a broad contours of what I'm essentially looking forward from the budget.
Just, sorry, Venu, just one thing. Fiscal deficit will still be contracted, right? You're saying, because expectation is a contraction of 15-20 basis points from last
So it should be, yes.
You're saying that will not happen, and you think they may just leave it for this time?
No, so the thing is, my understanding is that if the glide path is followed from a ritualistic perspective, you want to bring down your debt to GDP from, let's say, 56 to 50, and you every year even it out, then you need a 10 to 15 basis point sort of a reduction in fiscal deficit, assuming 10% nominal growth. Because nominal growth is higher, then you could have a better path. So at this juncture, my thinking is that the government might want to bring it down by at least 10-15 basis points even this financial year. I'm basically saying that please don't cut it. Keep it at 4.4.
Okay, so keep the fiscal deficit as is. Venu, hi, morning. On that point about capex, you're saying your expectation is at the least the capex expenditure should be 10% plus. If we do get around 10, 11%, it will be largely in line with the nominal growth. So will it really excite the market as a growth impetus or stimulus? And in that, defense spending is expected to be higher. So what is your own expectation? And if we do get a pretty decent number, say 15%, 20% increase in the overall defense allocation, is there enough in the valuation headroom for the defense stocks for it to be a play?
Yeah, so broadly, it's a matter of expectations. If you were to just broadly look at the last 2 years, we've been doing sub 10% rate from a capex standpoint, because in 2024 we actually didn't grow at all. So anything above 10, in my view, is still respectable. Remember that allocations in terms of capex are very different from future orders and future pipelines, because you incur what is already been established in terms of executable orders, right? So there's a limit to how much you can accelerate capex. So that's one defining part of the view. So the only way to actually sort of deliver more quicker gains is to essentially incentivize private sector who can expand capacities. And private sector expansion of capacities doesn't need to be mega expansion of capacities. They could very well do smaller capex, investments to cruise up capacity, for example. So this is an overarching view on capex. The second part is on the defense side of things. Honestly, I don't have a fine print on individual areas. Yes, I do believe that defense should be probably higher than the 10% number, right? So 15% plus is ideally what should defense be in terms of the expenses. My view broadly is that defense is appearing as more a secular area, which means this is not a one-off expenditure growth. There is a room for this sort of an expense growth to continue for at least a couple of years. So in that sense, I would probably say that I'm a bit more positive on the defense pack in general. I would have individual preferences, which I really can't share, on the channel. But the idea is that within industrials, I'm overweight defense heading into this year.
All right. Hi, Venu. Good morning. Good to see you, Ben. How are you all placed on this entire metals melt-up that we have seen? It's been a one-way run, right? It was a very strong close to 2025. And 2026 has started off maybe with too much of enthusiasm. How are you all placed out there? Yes, on select metals, there is going to be a bit of a demand-supply gap. But otherwise, it's getting a little bit tricky, right? Your take?
Yeah, so I will just highlight that my broader view was I was a bit nervous about potential for prices to rise, because that had real-world economic implications, especially with respect to margins for corporates. But when it came to a sectoral call, I started the year with a neutralish call primarily on metals. And the perspective was from a listed universe, looking at two main aspects. One is where they are on valuation curve. And number two is what is the expected earnings growth. I felt they were more closer to the upper end rather than the bottom end. So there wasn't a reason for me to be overtly enthusiastic relative to other sectors. So that's mean by broader stance.
Right. So, Venu, the view is neutral on the space. Sorry, just to summarize.
Yes, that's right. Neutral on the space in terms of listed equities.
Okay.
Right. So we don't have individual names that we cover. So no specific individual. So no nuances on individual metals per se.
Okay. Any feedback on real estate from your team? We saw that, in a way, guidance being lowered by a real estate company out of NCR recently. Stocks have been they were falling last year. I think they've started this year on a poor note. What's your sense?
My broader thinking is this: that look, if you were to look at real estate broadly, the weakness in terms of both equity market reactions as well as earnings impacts were started about 12 to 18 months back. And I call it as a mid-cycle situation in a 6-7 year upcycle. So what it means is what you see is basically already well understood in terms of the potential corrections in earnings. I do believe that things will bottom out. And that's what my broad thinking is, because when you have a new set of projects launched, it takes a while before you start to build up on your next stage of revenues. So this is a very typical classic mid-cycle situation for real estate stocks. The way I would look at it is that valuations wise, they have materially corrected as well. Stock prices are probably half of where they used to be at the peak for some stocks. So I would be more inclined to be looking at this opportunity to invest rather than to be looking at it negatively. Return expectations, however, could be very different. So it is not that we are, as I was telling you earlier this year as well, that I would find it very hard to get any sector with a very high return expectation. As long as anything does better than 7-8% on an annual basis for me on a 12-month hold, that's good enough as a buy for me.
Yeah. By the way, we have Irfan Razak of Prestige joining us in just a bit. Venu, I just have one more question. Another sort of equity analyst who writes thoughtful notes, Sanjeev Prasad, right, of Kotak, recently put out a note. It's a question he put out there, whether this is a temporary correction or perhaps a more permanent reset of valuations in India. And I think that question is relevant because, when you run a screen and you find stocks down 30-40%, and you say, well, it's attractive now. But if Sanjeev's point is perhaps true, I mean, if the answer is in the affirmative, then it becomes a very tough kind of place to assess what to buy, even with price damage in. What's your sense, briefly? And I know it's a question which requires a longer discussion, but Venu, any thoughts?
Yeah, I agree with you. We'll have a probably 30-minute separate discussion on this. I would probably put it this way that, as long as domestic money can't invest outside and there is a lot of domestic money still flowing into equities, there isn't a case for a massive derating of price to earnings for the market. So what you get is earnings growth. That's the way I would look at it. Look, I'm neutral in India. As you know, I cut India to a neutral beginning of the year, but I've still been saying that I'm not a seller. I'm not expecting a deep correction or a sustained correction because I think macro is stable and we are still seeing a room for earnings to be better in the upcoming calendar year, this calendar year versus previous calendar year. So that's where I broadly am at this juncture. So I'm not really looking at India derating for the next couple of years as a starting point when I think about India.
Got it. Okay. All right, Venu. Always a pleasure speaking to you. Thanks a lot for joining in. Wishing you a good rest of the day and a good weekend ahead as well.
Thank you.
Well, let's turn our attention to the real estate space then. We have Mr. Irfan Razak, the CMD of Prestige Group, who joins us to discuss the real estate sector's expectations from Budget 2026 and also brief us on the demand trends. Hi, Mr. Razak. Good morning. Always good to speak to you, sir. Well, in the past, you've said, right, that overpriced products, they struggle a little bit. Are you seeing any signs of price resistance in some of your key markets like Mumbai or Bengaluru?
Good morning. I have always said this, I'll repeat it again, that if price goes up too fast, too high, then there has to be a little bit of a struggle. We at Prestige have kept it at a very, very, very comfortable level. So we don't feel that pinch. And we definitely want to make sure that we make two ends meet. The only reason why the price goes up is you get too optimistic and you would make wrong deals. And you tie up land at very high numbers and then unable to sell it at a competitive price. Because we definitely do have to look at our bottom line also. I think keeping all that in mind, I believe that even at these levels, there should be no stress. And from here on, if we can stabilize, it'll be good for us.
All right. So you're saying as of now, we're not seeing price resistance and demand is as good as you expected?
Yes, demand is good. You see, now for me, the parameter is when we do a brand new launch. In the first month of launch, if I'm able to sell between 30 to 50% of the inventory, that's when I would say the demand is still there and there's nothing to worry. But if I do a big launch and then there's a large amount of inventory and I'm just able to sell between 8 and 10% of the inventory, then there is something going wrong somewhere and we need to really wake up and start thinking what happens. So I think that situation is still not come. And I hope it never comes because we are quite sensitive to what we are doing.
Mr. Razak, good morning. Thanks very much for joining us. I'm sorry. I think you've given us an answer, but maybe one more before we move on to other things. Any views, sir, at all on the NCR market specifically? I mean, that is, at least in the last 20 years, that is the market which goes into a frenzy and then it's also the first to start to, because there's so much speculative activity as opposed to, say, a market like Bangalore or Mumbai. How's the situation there, sir?
Yeah, I'm a newbie in NCR. We've just done one development, one project we launched, and to our luck, and I believe we positioned the project right, and we priced it correct, and we had a runaway success there. Now we have tied up a few properties which will come into the market shortly, as and when the approvals come, and as and when the due diligence and all that is tied up. We are quite aware that there's no sense in being over optimistic, overpricing the product, and then not finding a buyer. Like you very rightly said, that is a market that we need to watch, and we should avoid speculators. Like in our first project, that is the Prestige City Indrapuram, we completely avoided the investors. There were many people who wanted to do bulk sales. We only sold individual customers, and I think that's the strength of the project itself. So we are very, very, very safe on that. And hopefully, as we go along, let us see how things pan out.
So, any early indications of what FY27 might be for the company in terms of launches, in terms of a pre-sales guidance? How would it compare with FY26?
The FY26 itself, we believe that we'll end up in a high. Yeah. We've already crossed that 22K mark, and we should, the teams say that they will take us to about 30K, which I believe which is very, very possible and which will happen. But now, if I reach that number in FY26, obviously FY27, we have to plan hard, we have to work hard to see that we at least stabilize there or maybe grow from there. There's a lot of inventory in the pipeline. It's only a question of how quickly we can bring that inventory, where we can bring the inventory, which geography, and which micro market. So that is, the teams are at it all the time. It's like a complete, pressure cooker situation. And we are, I think we've learned how to work with pressure. And I believe that if all things being equal, we should do better in 27 than in 26. Okay. Though we've done fantastically well in 26.
Okay, all right. Mr. Razak, the next big queue is going to be in the next 48 hours, Budget 2026. Give us your top 3 expectations that you have from this budget.
As far as real estate is concerned, on the budget itself, I don't think anything's going to happen. Honestly, there's no expectations at all. But the one that we have been working with the Finance Ministry, with the GST sources, is two top things. If that changes, I think the first point which you brought up, where the prices have gone up very high, is today we don't get the input credit on GST, and then the price cost just has gone up mindlessly by 18% without knowing. It's a silent killer. And then over and above that, the customer does have to pay a 5% GST on their product. So that has to be necessarily passed on to the customer. That adds to the cost. So but of course, this is not going to happen in the budget, but that is what we've been talking of. And then there's another pain point is there's some misunderstanding on this commercial property and on joint development of commercial property. There is a GST when you straight away sign an agreement, which again is unfair. We've been talking through various associations on this. Hopefully some sense will come, and we are just asking for justice and equity where it's not going to be double taxation. If these two corrections happen for the real estate, it will help. I think in all other respects, I think whatever had to be done for real estate has been done. I don't think we need any more SOPs. All we need is a level playing field, what we call early approvals, which are nothing to do with, again, central government. It's all supposed to do with the local governments. If that happens, I think we can still keep doing business. After all, this sector churns the economy like no other. We support more than 200 plus ancillary industries. And as long as this sector is robust, employment, labor, all that will keep happening. That will keep churning the economy. I think that's the only thing that needs to be recognized. At least if we are recognized, that's all the satisfaction we get.
Absolutely. Mr. Razak, we'll leave it there, sir. And we'll speak again. We'll request you to come back after the budget. Thank you for joining us for now. Appreciate it. Manappuram is down 4%. Gaurav is here with details. Gaurav, take it away.
Well, as for Manappuram Finance, what happened is that the quarter was actually a bit weaker than the street's expectation. And why is it hurting the stock is that given that it is a gold loan portfolio that Manappuram has and they have shown a strong growth there, it is the profitability which is hurting right now. So first, let's talk about the numbers. Net interest income that declined almost by 14%, PPOP growth that came down. I mean, PPOP declined by 30% on a year-on-year basis. Now, both these numbers were more or less in line with the street's expectation. What happened is that the provisions. Now, if you look at the credit cost, street is expecting credit cost to decline almost by 80 to 90 basis point, but the credit cost has declined just by 40 basis point. And the main reason is that apart from the gold portfolio, the other portfolios like their Ashirwad MFI portfolio and the housing loan portfolio, where we are seeing some kind of pressure, and that is the reason why profit declined higher than the street's expectation, and that is the reason why we are seeing some fall in Manappuram Finance right now.
Gaurav, thanks very much for that. Well, we'll stick with financials. Mr. Hardeep Singh Ahluwalia is MD and CEO and Executive Director at Canara Bank. So thank you very much for joining us. And it's always great to speak with you on the numbers. You know, in the second quarter con call, you had mentioned that NIMs have bottomed out. There was another rate cut in December. So could you tell us, NIMs now are at about 2.45%. Where do we go from here? There is, of course, also a fair bit of competitive intensity, right? I mean, fight for assets. So what guidance can you provide for us, sir, on NIMs?
Sir, if you see the 9 months NIM is at 2.50. So if I see for the full year, the yield on advances has dropped 45 basis point. But the cost of deposit has only reduced by 8 basis point. So whenever there is a rate cut, immediately since our 49% of the book is repo linked, so we have observed that 125 basis point has been cut during this financial year. Starting from February, it has been cut. So that has resulted in immediate passing of this benefit to the 49% of the advances portfolio. Whereas the cost has not reduced to that extent. That has resulted in some decline in NIM. But if further rate cuts doesn't happen, we think that it will stabilize here. And once the repricing effect on the deposit is happened, then we see that NIMs going up from this.
For NIMs should be similar to Q3 levels, stable 2.5% in the absence of no rate cut?
Yes, I believe that it will be in the range of 2.45 to 2.50 because 17% of my bulk deposits are still yet to be repriced.
Okay, and Q1 onwards, what is the kind of recovery that you expect in NIMs? And what happens in the event there is a rate cut? Then how will the NIMs get impacted?
In case there is a further rate cut, because CPI inflation is now coming to 2%, then the expected of 2.6%. In case that happens, then we may see some contraction also, but it will be a range bound from 2.45 to 2.50.
So, you know, a slightly near-term question, right? Because credit growth is just about started to pick up. System-wide credit growth started to pick up. I think the last RBI data showed that. Fortnightly data showed that. And I think we're due to get the new set now. Is it really picking up? You know, when you look at fortnight to fortnight, I mean, do you see that acceleration in credit growth?
Yes, sir. If you see Canara Bank, we have posted a strong growth in credit side. Against our guidance given 10 to 11%, we have grown at 13.59%. That growth is primarily driven by my RAM credit, which has grown by 18.70%. And the RAM composition has increased from 57% to 59%. So we are driving on RAM where the spreads are more to take and very, very conscious on corporate pricing. But we see that this traction will continue in the fourth quarter also, because for the 3 quarters, our credit growth is very good.
And on RAM, which segments are seeing the most absorption?
Sir, retail is growing at 31.37%. My housing loan is growing more than 17%. So, and gold loan portfolio also, it is increasing by 30%. So here we see that even in MSME also 13.74% growth is seen. So RAM, all the sectors are growing in RAM sector, retail, agriculture and MSME, all these sectors are growing.
Mr. Ahluwalia, good to have you on the show, sir. Since you briefly mentioned gold, let's take that point a little forward. You know, your gold portfolio, I think, was around 2.1 lakh crore. You could correct me on that number. And out of that, the retail portion was around 62,000 crores. Could you give us an update with regard to how both these two numbers are shaping up? And given the kind of interest in gold, gold loans as well could see a bit of a tailwind. As a percentage of your book, where do you see this number headed?
Yeah, as on date, my gold portfolio is 2.21 lakh crore, of which agriculture is 1.48. The rest is retail only. But it is growing at a healthy pace of 30%, and it has dual advantage. The retail ones we can offload for PSLC commission, we also gain. And the slippages are very, very less in gold loan. The NPAs are minimal in that portfolio.
Okay. So get that number right. The retail gold portfolio has moved to around 73,000 crores approximately, just driving the number that you said.
Sir, exactly. Yes, sir. Yes, sir. Yes.
Sir, corporate, growth, the loan growth has been quite subdued. It's RAM, which is retail, agri and MSME, which is driving growth for you. So corporate, I think loan book was just about 7% kind of a growth. What is the guidance on corporate and even on the overall loan book? Do you stick with 10 to 11% or do you think there's upside?
Madam, we are already growing more than 13%. Our advances growth is 13.59%. And we have entered the final quarter. So normally in the final quarter, the growth is more. So already whatever momentum has been gained, whatever proposals we had already processed and sanctioned. In corporate, we are very, very mindful of the pricing. So wherever good pricing is coming, we are going for that because our net worth is quite high. So we corporate, but we are only very, very conscious about the pricing. But this trend in advances will continue in the final quarter also.
And what about, sir, your ROAs? There was a bit of a one-off in the past quarter, but what are the levers you have in place to improve it from here on? If you could give us an absolute number that you end this year with and for the next year as well?
Yeah, my ROA is at 1.13%. It has improved from September, one notch it has improved. And going ahead also, I see it will be maintained at the same level.
Thank you, Mr. Ahluwalia, for joining in. That's the guidance coming in from Canara Bank. NIM should remain stable or between 2.45 to 2.5%. And even on advances growth, while the bank's guidance is 10 to 11%, in the first 9 months, they've clocked in a growth of more than 13%. And Q4 is also typically strong. So it looks like, in all probability, they will exceed that guidance there. But the stock is under pressure, largely on account of the NIM performance in Q3, where it fell short of expectations. Get into a break. On the other side, the management of KPIT Technology will join in to talk about the Q3 performance. Stay tuned. Welcome back. KPIT Tech is the next management on the show. The revenues came in flat at $181 million. Caresoft and Endream contributed about 3.4% to the company's top line. But the company is also guiding for better growth in FY27 compared to FY26. Sachin Tikekar, joint MD of KPIT Tech, is now joining in. Mr. Tikekar, morning, and thank you very much for joining in. While your overall constant currency revenue growth in Q3 was 1.5%, you did say that the acquisitions contributed 3.4%, which means the organic revenue growth, the growth X of acquisitions, was negative for the second consecutive quarter. What can we expect in Q4 in terms of organic revenue growth? Will it continue to decline? And what exactly is the reason behind this continued softness?
Okay, thank you, and thank you for having me. Let me take questions one by one. So first of all, you're right. The calculation about the quarter-on-quarter growth The degrowth, actually, if you take out the joint business that we've been doing, is actually to the tune of less than 1% for this quarter. And as far as the future is concerned, we believe our Q4 is going to be our best quarter in terms of growth in revenue. We also feel that there will be an uptick in our margins as compared to Q3 in Q4. But more importantly, we feel that FY27 is going to be better than FY26 for us. And given the transition that the whole mobility industry is going and the way we are trying to transform our company, we remain very bullish on the midterm.
Okay, got that. You said Q3 degrowth was less than 1% if you remove the joint venture business?
No, if we remove the programs that we've been doing together with the acquired entities over the last 2 quarters.
Okay. So when you say that Q4 is going to be a best quarter in terms of your revenues, should we at least firmly say that it will grow, organic revenue will grow in Q4? If yes, could it be 1 to 2%, 2 to 3%? Give us some indication because the first, yeah.
There is going to be growth in Q4 for sure. Like I said, it's going to be the best quarter for this financial year. There will be growth. We don't provide very specific guidance for the next quarter. So all I can say is there is going to be growth and we are going to be in the positive, and there is going to be growth coming back in Q4. And I think the margins are likely to be better in Q4 as compared to Q3.
Okay. Got that. Last time you also spoke about an impact. This was in Q2 because clients are deprioritizing certain spends from their old program. There was also a revenue loss due to cannibalization. This was in Q2. Has something similar happened in Q3?
Yes. See, it's a complete transformation in the business. So just to put things in context, the mobility industry, on an average, the revenues are down more than 10 to 15%. In the mobility industry, the profits are down by 50%. And so far, we've been able to hold on to our margins, whereas most of the others in the entire ecosystem have not been able to hold on to the margins. So it's a big churn that we've been experiencing for the last couple of years. The good thing is, I think things are getting stable now. I think the OEMs have a much better handle in terms of what their markets are and where they really want to spend money, which is a good thing. And those are the early signs of some green shoots that we are seeing. That means they will deprioritize their spend in a bunch of areas, but they will prioritize spend in some of the areas. And we have clearly identified which those areas are, and that's where we are actually engaging.
But last time you specifically called out a number of $65 million as revenue lost because of these two things, deprioritization and revenue cannibalization. Is there a similar number in Q3?
It's a similar number in Q3, and we believe it will continue because it's a complete change from a services model to a solutions model, which is going to be AI infused. This is something that is going to happen. In most cases, we are prioritizing cannibalization of our competition. But in some areas, in order to help our clients do more with less, we also have to cannibalize our services business so that we can offer them solutions that are cheaper, better, and faster to implement.
But those, Sachin, hi, morning. Those services are also, the solutions are also services, right? But of course, in a holistic way. The way you offer them is different compared to how you would do earlier.
Yes, services are very linear and solutions are at least 50% non-linear. That's the difference. That's how you are able to shorten the time to market substantially and also provide...
What is the difference, Sachin? Services and solutions?
Services are linear in the sense you do a project and it's a human effort for the program. And when you have solutions, there are a lot of reusable components that are readily available. Hence, you have a head start of minimum 50%.
I see.
Right? That's the fundamental difference between solutions.
But wouldn't the recurring revenues on the solution side be lower then?
See, the effort is to take a bigger view of the client's problems end to end And the effort is to solve the bigger problem so that the revenue doesn't go down, but it makes things more efficient for the clients. And at the same time, we don't compromise the revenue. And hopefully over a period of time, the margins also go up.
Okay.
That's the effort.
The deal wins, Sachin, this time around about $200 million. Average has been about $230 to $240 million.
Yeah.
So is there a bit of a slowdown here, and why?
Well, I won't call it a slowdown. It's about 10%, little bit off. And it's not a slowdown, 10% is just pretty normal. The order book is pretty solid for as we walk into Q4 and as we look at next FY 27. There are no specific reasons for the drop. I think we'll have a little more balanced growth as we get into FY 27.
Okay. Hi, Sachin. Good morning and good to see you in. Let's focus on a couple of your verticals then. The US vertical as well as the Asian vertical. Now, in US, you saw a bit of a degrowth. When does the United States business recover? Point number one. And on Asia, we were talking about incremental business coming in from some other countries. But it's degrown yet again. What happened?
US, first of all, is stabilizing a lot more. That's where there were substantial cuts in terms of the budgets. And what we are doing in the US, why we feel a little more optimistic about US is our business in trucks and off-highway is growing in the US. So it's not just the dependency on pass car anymore. So we feel pretty good about US coming back to growth in Q4 and, the early part of next year. In terms of Asia, I have to say we'll see growth in India and China. We'll see growth in Southeast Asia. I think it's just a couple of large programs getting over. That's why I think there is that adjustment that we have to go through in Asia. And Asia will go through that churn for some time, but net, I think we should see growth in Asia as we get into next financial year as well.
Margins declined by 50 basis points. Could you give us a breakup of that? Because last time when we spoke in Q2, you were hopeful of managing to maintain your margins despite the increment, but that's not played out. Margins have dropped. And in Q4, what could be the extent of margin improvement?
So let's break up the 0.5% drop in the margins. More than 0.3% is on the account of wage increments that we did. And the rest of it is just the regular business churn. And as I mentioned earlier on, compared to this, we expect the margins to go up in Q4. It's kind of hard to be specific in terms of how much, but all I can say is there will be growth in margins as well.
You said, I think you said mobility industry revenues are down 10% and profits are down 50%. Is that correct?
You look at all the global OEMs across the world, their profits, and you look at the ecosystem of all the tier ones and all the tool makers, there is a dramatic drop year on year. I think the only outliers in terms of growth are the companies based out of India. I think Mahindra has done really well. So has Tata Motors comparatively and Maruti. But that's not the story when it comes to our clients in US, Europe, Japan, or Korea.
So for your clients, what is the expected tech spend?
The tech spend went down. It went down by on an average, about 20 to 25% in the calendar year 2025. As I said, we don't expect the spend to go up net. However, as I mentioned earlier on, in some specific areas like digital cockpit, areas like cybersecurity, then propulsion and after sales and diagnostics. These are the areas where we think that the spend will be greater. Even in some parts of the world, the navigation on autopilot has become a necessity in most of the vehicles now. So that's where we expect the spend to go up a little bit. And, those are the areas that are well within, what we specialize in.
Thank you very much, Sachin, for joining in. Always a pleasure chatting with you. That's KPIT Tech, hopeful of a better quarter, Q4 in terms of revenues and margins, and even FY27, though the industry outlook is pretty tough still. Gaurav now joins in for a little more on Paytm. Gaurav?
Well, yes, if you look at Paytm, the numbers were actually in line with the street's expectation. In fact, if you look at revenue, that increased almost by 20% on a year-on-year basis. And company also said that on a like-for-like basis, if you compare the revenue, it is up almost by 25%. Even if you look at the contribution margins, we are seeing some kind of expansion on a year-on-year basis. Now, when it comes to indirect expenses, company has actually contained it very well. It was down almost by 8%, and that is the reason why EBITDA margin now they have improved sequentially by 22 basis points. And even the profit number that has increased almost by 6% on a sequential basis. Now on a year-on-year, this number is not comparable because there was a loss that they reported in the same quarter last year. What is happening is that there was a comment on the PIDF incentives. Now company is very confident that the PIDF incentive amount, whatever they have lost, will be gained from higher revenue and targeted sales efforts. Remember, company has quantified this number as 216 crores that they have received in the 9-month FY26 so far, and they are confident of achieving that number again. At the same time, commentary from the management that also remained very confident. They said that the company will welcome all the initiatives taken by regulators and governments, but company is not completely dependent on the PIDF or any other grants. They have a different business model which is sustainable. Second is that company is strictly the business of payment and financial services. And lastly, they are also emphasizing on the fact that they will bring back the wallet business. So all in all, the commentary remained positive. Numbers were in line. There was a pinch of salt in terms of the PIDF incentives that are not there anymore. But at the same time, given all the positives, and at the same time we are also seeing some pressure in the market, we saw Paytm stock also falling, but we are seeing some kind of recovery after the call which concluded just a few moments ago.
All right, 11:50. Thanks very much for that, Gaurav. We'll take a break. We're back. We're going to be joined by the management of Container Corporation to discuss the quarter gone by. Stay tuned. Welcome back. Container Corporation reported a muted said revenue growth of 20% led by higher payments, GMV, merchant subscriptions and distribution of financial services. Sanjay Swarup is CMD Container Corporation. Sanjay, good morning. Good to have you with us here. Appreciate it very much. I just want to start by asking you for on the EXIM side and domestic volumes, what should we expect for this remaining quarter? And more importantly, FY27, because I mean, if you look at the prior year, that is FY25, the volume guidance has been missed by a large number. So just wanted a sense, realistically, what should we expect?
Yeah, good morning. As in the beginning of the year, I had given a guidance of 10% growth on EXIM and 20% growth on domestic. Total growth of 13% for the company. You must have observed that at the end of Q3, we are on, as far as EXIM is concerned, we are having 10% growth. We are maintaining growth of 10%. Domestic, there is a growth of 13% for up to Q3. And overall, we are showing a growth of 11%. So we are slightly short in domestic as far as the meeting the guidance is concerned. And in Q4, actually, we are expecting a good volume in domestic also. Of course, EXIM will continue to show a strong growth. In fact, in this financial year, EXIM will give us a revenue of more than rupees 60 billion, which will be all-time record for EXIM for our company. And this will be an excellent growth as compared to last year. As far as domestic is concerned, we were expecting that tank containers will be supplied in Q3 by our suppliers, but somehow they got delayed. But now we are getting a supply, one rake we are getting every month. So we are, our bulk cement loading, which was dependent on supply of tank containers, that was a major part of domestic. Now it is taken care of, and in this Q4, we are already expecting a good loading in domestic. So by and large, I am very hopeful that we will be able to meet the guidance that I gave at the start of the financial year. Now, as far as the FY27 is...
No, go ahead, sir.
Sorry. Yeah, as far as FY27 that you were asking, final guidance I will be giving at the end of Q4 But roughly, I can tell you the indicators that we are seeing, they are quite encouraging for us. Western DFC is likely to be commissioned up to JNPA by March 2026. It's on target. So we are very hopeful that we will get a very good growth in Exim. More than 15% growth I am expecting for next financial year, even for next 3 years in succession. Back-to-back 15% growth we will expect in Exim. Similarly, in domestic, this bulk cement product is now taken off. Industry is very, pleased with the product, and we are seeing a very robust growth of bulk cement loading. And apart from that, we are tying up with big giants like Petronet, GAIL, and big corporates like Vedanta, Tatas, Jindals for domestic business. And for next 3 years, I'm projecting a very good growth, more than 20% growth in domestic. So this will finally, at the end of FY29, I am expecting at least 10 million TUs throughput, and in terms of revenue, rupees 15,000 crores. That will be top line estimate by FY29. Seeing this much demand and growth potential, yesterday our board of directors has approved increase in capex by 23%. You may be aware we are given a target of 860 crore rupees for this capex. The budget has been enhanced by 23% now to 1060 crore rupees, and which we are basically utilizing for procuring more rolling stock, more containers, and seeing a very good growth in demand, very good growth in business. Board of directors have taken this decision.
All right. Thank you, Mr. Swaroop, for sharing that medium-term guidance, 15% on Exim and 20% on domestic volumes for the next 3 years. In the past, you've strategically taken price cuts to boost volumes. In the horizon, are there any price cuts on the anvil?
No price cut. Actually, as I already maintained in all the calls, we don't do price cut just like that. What we do is, suppose as a result of our operational, excellence, we save some cost. We share the cost with our customers. Right. So our company philosophy is we give good service while maintaining a good margin also. That has been the philosophy for the company. It will like to continue in the future also.
What will margins look like 3 years hence with this kind of growth?
Yes, we will sustain the margins, and with this 24-25% EBITDA that we have been maintaining, and for the next 3 years also we will be maintaining this kind of EBITDA margins. We are quite confident of that.
And this capex guidance increase by 23%, is that for FY27?
No, actually this capex budget that I have given is for FY26 only. That 23% increase in capex budget. For FY27, I will give in next conference call after Q4.
We'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate it, sir, for being here on CNBC-TV18. 130 points lower on the Nifty. There's a recovery, about 40-50 points off the lows, 25 to 90s where we read commodities are down. All these silver, gold, ETFs are lower, and MCX is down about 3% as well. The entire complex, commodities and things around that core commodities, exchanges included, are seeing profit booking. They've had a fantastic run this year so far. We take a break. Lata discusses the state of the global and Indian economy ahead of the budget. Vishnu Rana, economist at S&P Global. Kanika Parishya, Chief Economic Advisor at Union Bank of India, with her on the other side.